Hey there, everybody. This is Dan Gandy from Investing in Oregon, and we want to go through the 7 deadly sins of house flipping. These are actual mistakes that will kill your profit and your projects through real life applications and the insights, the gold nuggets that you want as a house flipper, wherever you are, across America and any country, so that you can make informed process and system decisions and not lose your butt on the back end when you go to sell a property. These actual sins are what I have gathered from working with tons of house flippers and flipping myself and seen millions and millions of dollars transactions on the investment side. So stay with me. These are the 7 deadly sins of house flipping, and we're going to break them down step by step. All right. First and foremost, underestimating the rehab budget is pretty much the biggest mistake I see. A lot of times that's because the relationship between the contractor and the investor, or the contractor is not the investor and the investor is not the contractor, and having a firm understanding of what a shall not exceed bid is versus a bid that is going to include change orders as you open up things, especially when you're looking at properties in the D and C asset class that are going to have issues that come up as demolition persists when progresses through the project. So one thing you really want to understand is the rehab budget and making sure that you're working with a licensed contractor that is going to have a provable track record of keeping things on time and on project deadline and project estimate. That is really, really important. Always adding a contingency of 10 to 20% and getting multiple bids from licensed contractors so you can see the spread within the local industry on what specific things cost is very important. And creating that relationship with the contractor and letting them know, hey, I only have $75,000 to spend on this project. If it goes to 85, I'm done, you're done, we're all losing money. So one of the big investor tricks that I'm going to share here is building a spreadsheet that tracks every estimate and invoice you get from every contractor, vendor, supplier, subcontractor, and itemizing it by trade. This is something I learned in the design build business as we did tons of different remodeling projects, design build, home building. And what we did is we created this library archive of vendor costs. This spreadsheet was broken down by trade. It then worked through having a categorization to the next level by breaking down the price per square foot, price per linear foot, price per square for roof, price per unit, price per delivery, hourly wage, how much in the bathroom costs us, X amount of square feet, how much is a kitchen remodel at this finish level or this finish level or this finish level. And what we did is we created a unit cost for every single invoice or estimate we ever got. And we archived them in Google Drive. We created a spreadsheet and we tracked all of it. So when we went out for a future project, we knew exactly what a subcontractor would cost to us, unless there was some major swing in material cost or scope of work. And that gave us a really tight budget to work from. And this allows you to track every trade and also test other contractors in those specific trades to see if you can keep those bids in alignment. And I also use that spreadsheet as a negotiation tactic with contractors to be like, look, last time I had this done, somebody did a roof for X amount of dollars. If you're not willing to do it, I'll move on and I'll call that other person. The reason we're trying to work with you is your availability is open versus the other person that we just need to wait 1 or 2 weeks. It's really not going to change the project. And so negotiations were done. Value engineering was done by using that spreadsheet to be able to build an archive and historical trend of what costs we were doing to keep the rehab budget on par. That's all it is. Now, next sin is overestimating the ARV. After repair value, and I get this with sellers just in the retail residential market, they are hoping and being optimistic using comparable sales that they're going to have the highest price per square foot sale or the highest comp once their project is done because they are emotionally connected to the project. But what I see is the market sets the value. The amount of buyers in a current zip code that are pre-approved or have cash at any given time can change. So you need to make sure that you run very conservative after repair value comps. And you need to have not only a real estate agent or appraiser that you're working with, but setting a boots on the ground valuation, which means you have somebody who's constantly reviewing and looking at comps in the market, and they're looking at all aspects of that. And that's really where this investor trick on this sin comes into play. You need to create a spreadsheet tracking sold properties over the last 7, which is 1 week, 30 days, 60 days, and 90 days to match your exact project. And what I mean by exact project is within reason, an after repair value comp that has the same finish levels. On this spreadsheet, you need to have more finite information that most real estate agents will not provide unless you ask. These things include list to sale price ratio. And if you're not familiar with list to sale price ratio, we're not talking about the price they brought it to the market, but the price that the property was at when it went pending, and then where did it sell at. Anything sub 100 means it's sold for less than it was listed at its current time it went pending. And what you're wanting to do is study the trends that you're seeing. So if you see a market that's selling at 85% to 90% list to sale price ratio, that tells you there's about a 10% sway from the time or the time it was listed and went pending to the time it actually closed. 10% swing does not include the realtor commissions. That was a concession. Those were closing costs. Those were a price reduction offer. And that can tell you that lower than asking offers are being written in that zip code, which means you have to be very conservative and buffer that cushion when you're looking at the after repair value of that comp. Also, you need to look at the private remarks. You need to look at the days on market and how long things are sitting. And you got to look at the price per square foot of the lot and the acreage that it's on as well, not just the house square footage, but also what's the price per acre that is added onto this property if we're comparing apples to apples of a sold property versus the property we're going to flip. You need to look at active inventory available and median sales price in that zip code. These are things that you pretty much are doing as an investor, but you want to make sure that you're looking at all data points. These data points is going to allow you to have a clear, conservative outlook of pro forma, which means your exit strategy to sell the property is most likely going to sell between X amount of dollars and X amount of dollars. And we have looked at all of the research to make sure that it's predictable within 90 days or 60 days or 30 days on market. You also can then pivot here in all of this is to track these active sales on this same spreadsheet, which means while you're doing the project, you look at comps that are active and you track them and see historically where they're falling. And if you see an upward trend where there's limited availability and supply and demand has changed when you're about to finish the project, you may be able to actually test the market and raise the valuation. We've only done one failed appraisal, which means the appraisal came in about $7,500 short on a project that we actually raised the price almost $25,000 because there was no supply and there was tons of demand in that zip code. So active monitoring of things that are active going into pending then sold, and then having the right key performance indicator data on every listing that is a sold comp is really going to set you apart. It's also going to allow you to measure what I call zip code velocity, which is a key to making any timeline pivotal decisions in your project and the seasonality of such delays or timelines, which means if you ran into a change order or a thing that could add another 2 to 4 weeks to your project, but it really is not detrimental of getting the project packaged up and listed and sold, maybe you don't make that change based upon the research that you've seen or the change in the market or a decline that is suddenly happening. You need to have what I call real-time intelligence when it comes to overestimating the ARV or estimating with good conscience that this is what you're going to sell the property for. And that's the second sin. Next, I want to tell you about ignoring permits and having code compliance issues. I have dealt with this time and time again with investors that are trying to shortcut or trying to cut corners or trying to evade having to get permits. Guys, do not do it. A smart buyer's agent or a smart buyer is going to do their due diligence, and they're going to find out that you did not permit things because most of the time the state or local county jurisdictions are going to have a track record of what permits are pulled for that property. So if there's anything that has been done structurally, like additional bedrooms or additional square footage, that also flags to the tax assessor's office. So when you look at a TRIO report or a listing kit from a title company, it says that the house is 575 square foot on paper, but you're advertising it as 850 square feet on paper. Here comes the red flags to both the county and the tax assessor's office, because they're looking at your project. It's being advertised in the public's view, and you're not being forthright about where this additional square footage has been done and were permits pulled. Guys, I've seen projects get completely stomped out with FHA and VA appraisals not finding permits that were actually filed. I've actually seen inspections where things were done incorrectly and permits were never filed. I've also seen septic systems that were installed without permits that had to eventually lead to delays in the transaction up to 30 to 60 days to get the county out there to do a septic system permitting as an as-built. So you need to make sure you're not skipping permits and you're making a list of permits that you possibly need to pull when you're doing your due diligence before you buy the property. Now, the investor trick here is buyers with great buyer's agents will always ask for permits. So why are you trying to avoid it, right? Create a punch list of every item that will require a permit and get in front of the work with your contractor before you even close on the property. What is your contractor's experience pulling these types of permits? I just sold a duplex. We were adding an additional bedroom because there was additional livable square footage that could be converted. But the contractor that was referred to my investor didn't have experience going to the city or the county and getting the permits for additional square footage additions. You want to make sure you're asking your contractor before you move into writing an offer and closing. Next, make sure you have inspections on wells, septic, attics, roofs, crawl spaces before you purchase the rehab property, and making sure you don't have things that you're going to skate by and try to avoid doing in your project. The majority of repair negotiations that I've seen that are blindsided to an investor deal with wells, septic, attics, roofs, and crawl spaces. That's because these are all the items that people avoid because they're either a high ticket item or they don't actually physically want to go into those spaces and look for things like vapor barrier or look for things like pillars and posts or foundation issues or water damage or sump pumps. You really want to make sure you're looking at all of those aspects before you acquire the property. Keep great record keeping of all of your plumbers, electricians, contractor invoices, because you're also going to need this for early issue title insurance if you plan to flip that property before 90 days after completion. In Oregon, we have a thing called a super lien, which a super lien actually trumps a mortgage. Doesn't trump taxes or Uncle Sam, but it trumps mortgage in first position for anything that is liened against that property. So you need to make sure you have copies of all of your invoices, all of your contractors paid, and put them in a Google Drive and keep that project very organized. The title company is going to ask you, did you have any major construction done on this project in the last 90 days? And there might bring up the conversation that you need to show proof that you paid them all. So don't think you can start paying everybody cash and skating the requirement for a W-9, because it's also going to come up in the title policy, especially if you have a finance buyer. They're going to want to make sure that that title policy and that early issue title insurance additional cost to the buyer is been mapped out, and all of the risk for the title policy issuer is not going to be high or detriment to the title company issuing that insurance. So ignoring permits and having code compliance also comes into your due diligence, right? So that is the third sin that we see. Number 4 is poor project management. Guys, by far, I didn't rank this in the order of which most important to least important, but number 4 is by far the number one profit killer. Poor project management means having construction delays and holding cost nightmares, right? Contractors are going to ghost you. Materials are not going to show up. There's going to be missed inspections. It all adds up. A successful flip depends on tight timelines, whether it's a clear schedule, daily oversight, good vendor relationships. Project quickly lose momentum. And I see this, it just happened this week with one of my clients that has an investor or a contractor that they hired as an investor, and they're already seeing delays in week 2 after demolition because the people are not showing up on a daily basis. Every week you need to hold the property costs interest, taxes, insurance, and utilities. What I mean by this is that you need to know what your holding cost is every single week. You also need to know how much you're paying your contractor every single week or how many draws you're going to do. And the investor trick here is you need to create a visualization of the project is essential. So creating a Gantt chart and every line item work trade to be completed on your projects with corresponding estimated timelines. Almost like the same thing we were doing in cost estimating and every trade that was going to be involved in a project historically. We're also doing this for a project. Me and my business partner, if you need an example, just shoot me a DM. We've created a Gantt chart for flips that has every single line item of a project timeline all the way to completion. And what we see is how long each one of those is going to be project specific or dependent. But what you need to do is make sure you highlight the trades or the items that predictably take longer or have a coordinating of scheduling or timeline issues. Meaning, if you have electricians or plumbers or roofers that are always 2, 3, 4 weeks out, you need to make sure you're estimating that in your project management early on so that you can get them out to do an estimate and get them on your schedule way in advance, right? Next, keep a running list of all expenses and invoices on a weekly basis for total project budget versus actual spend to create a profit assessment at any stage of the project. This is super important. I just did this on a flip. I know at every week where I have my total spend has been and also my holding costs on a weekly basis. Like every week you hold the property costs you interest, taxes, insurance, utilities, and paying contractors, right? And interest on a hard money loan if you're doing that. Financial analysis is the most common oversight of a project that has seen investors fail. By having a tight leash on these items, you can decide to pivot quickly if there's any delays or change orders that come up. Just like monitoring comps in the market, you need to monitor your project from a financial analysis standpoint. Super important. I'll give you an example. When I went to list the property, we were listing for a certain amount of dollars. I asked my wife, hey, can you tell me exactly what the project spend has been so far? Then I subtracted realtor commissions, closing costs, and any concessions that we were giving. And I was okay with accepting an offer because I knew exactly what my profit margin was in real time. And you'll hear me talk about real time, whether you're in the Investor Alignment Academy or you're getting information like this from our YouTube channel. Now, as we progress even further, I want to talk about designing for yourself, not the market. This is the fifth deadly sin. And I see this a lot of times with husband-wife teams who watch a lot of TV, HGTV, and different house flipping shows. Your dream kitchen may not be your buyer's dream kitchen. Luxury upgrades in the modest neighborhood, that's a quick way to burn through profits. Also, designing your finishes layout with your target buyer in mind is something that we see a lot of people not do. A lot of times they'll go to Home Depot or find the cheapest thing or find the thing that is on clearance, and it's not attractive to the buyer pool or the current trends in the market that are selling properties quickly. You need to consult with agents. You need to consult with interior designers that know what is selling, both based on remodeling projects and also retail sales in the current market. You need to avoid over customization unless you're in the higher priced upper tier flipping market. And my investor tip in all of this is the first step is to find finish swatches for your entire project, including paint colors, hardware, flooring choices, cabinets, countertops, light fixtures, and everything else. Build a Google Drive again. Create exactly what it is and based by folders for finishes, folders for fixtures, folders for flooring, and create the template, right? Sometimes internet research will do, but one big hack in this process is hiring an interior designer to help you quickly find swatch and product breakdown. Pay them hourly, pay them per project. The upfront cost can be minimal to the long-term savings of having a trendy, desirable finishes in your projects that help sell that listing quickly. Build a flip template. Make it based upon research and actual input from people. And this includes folders with examples and pictures like we talked about. But next, create a spreadsheet of every vendor you plan on buying these items from and a link to the product if it can be purchased online. Many times flippers think everything needs to be purchased like from Home Depot or Lowe's because it's easily accessible. But you may actually be able to create even more savings or having a better trendy finish level from something that can be shipped to you in the project and being able to plan out those shipments and where they come so that they're not stolen from the front doorstep of a project or a property that is vacant. Make sure you're following the design for the market, not the design for yourself. It's always good to brag about how nice something is, but it's not so nice when you're not profiting or not selling the project. Now, that's the fifth sin. The sixth sin is having no exit strategy. And what I mean by this is if house flipper goes into buying a property and flipping it, your exit strategy is ultimately selling it. But flipping always isn't a straight line. What if the market shifts? What if it doesn't sell? Savvy investors always have a fallback. Can you rent it out long term? Would it cash flow as a short term or midterm rental? Can you refinance it out of the hard money? Always know alternatives before you buy. This is super, super, super important. My investor trick on this sin is when analyzing the property before you buy, always run rental comps. I use Rental Meter Pro for that. I can print out a pro report. I can also look at Zillow Rents and look at things that are actively on the market for rent. And what I'm trying to do is create the long-term rental comp in the event that I have to hold this property. Next, I'm also looking as running a report on AirDNA and also looking at Airbnb and VRBO and looking what the average daily rate is. What I want to see is what rental comps are in the short-term sector. Then what I do is once I have those numbers, then I look at what the monthly debt service would be in the event that I didn't sell it. I needed to refi out, pay the hard money lender out, and go use a standard Fannie Freddie conventional loan or a DSCR loan to hold the property in the interim because it did not sell. And a lot of times I'm looking at how much money do I need to get out of the project for a down payment, and what am I looking at in closing costs and fees and realtor fees, so that I know the full picture and cost in the event that I'm going to sell it versus in the event that I'm going to just refinance it and hold on to it. You can run projections on worst case scenarios with cash flow after debt service calculations. And a trusted spreadsheet for this analysis is an APOD, an annual property operating data. I also have a link to a short-term rental calculator that you can use, but I also have a copy to an APOD that if you need to use it, just click the link below, consult with me, and we can talk about it. That is the sixth sin. The seventh and final sin is flying solo. And we talk about this time and time again, especially with a lot of investors reaching out to me and they want to connect with agents. The first thing I want to try to talk about is you need to have a trusted team. I know a ton of house flippers, but the majority of the ones that are extremely successful have one agent per market. They don't play the non-loyalty game. They don't play the bring the deal to me and I'll use you game. The majority of the investors who are super successful have a really good real estate agent. That real estate agent is financially vested and has a relationship with that person, but also what they have is a really good contractor relationship, a really good lender relationship, a really good inspector relationship, a title company that they like working with. And ideally, this is nailed down to 1 to 2 people who really can support their business at scale in every market. You don't have to have the same agent across the entire state, but what you can do is create that dream team and stop trying to fly solo and stop trying to use your ego as I'm so busy and I'm so good as an investor that I don't actually need to build this dream team out because people are expensible. As soon as somebody comes to my business and acts like that, I'm out. I have enough business. I have enough marketing out there to find off-market deals, and I will support the investors that have loyalty, the investors that always come back to me, the investors that cherish my marketing and my insight through their projects. And that investor trick is having the best real estate agent possible is just the key of interviewing and asking for references and creating a relationship with somebody who has also connections to good contractors, lenders, and anybody else mentioned above. This prevents unforeseen profit loss and long delays on market, which increase holding costs. One agent is a key point here. They can help you build trust, loyalty, and long-standing relationship with those who have hands-on experience investing themselves. And through understanding of underwriting, financing, zoning, contractor costs, permitting, comp analysis, I highly recommend not working with multiple agents. And I'm not saying this so you reach out to me. I have multiple investors I work with. But one thing I'm always doing is my fiduciary relationship with them is I'm giving them every single tool, insight, and added advantage that I can provide as a professional because I have a relationship with them and they have created commission checks for my business. I'm not in the nonprofit business, but the last and most important point is the number of investors who are flipping houses that I've seen fail because their dream team sucks or they rely on wholesalers for deals. Anybody who tells you you cannot find good deals on the market does not understand negotiation, does not understand how to comb the MLS, but also you become dependent on wholesalers who are just going to give you garbage deals in the event they already have somebody above you that they pass the deal through from person to person to person. And now they're advertising it out after their VIP list has already seen all the projects or the projected profits of a project. The reason I know this is we used to run a wholesaling company, and I can tell you that's what happens. These 7 deadly sins are extremely important to understand and seem like common sense, but these investor tricks that I have put into this guide, and if you want the guide, click the link below. If you'd like to schedule a consultation, click the link below. I have a proven, repeatable system on how to help house flippers, A, find deals, B, manage their projects, C, make great projections on ARV and calculation of comps, and also help them and assist them through the project that has helped investors make millions of dollars as my clients. If you like my content, investing in Oregon, please hit the like button, the subscribe button. Please like this. I want to be able to provide you more value and information. And this is important to making good investing decisions, no matter what state you're in, but especially Oregon. Once again, my name is Dan Gandy, principal broker, investor consultant with the Operative Group with Real. We look forward to seeing you on the next one.